You are listening to chartingwealth.com for Monday, the 17th of August, 2015. This is our training and trends, and we're going to start off with SPY. What is that? It is Standard & Poor 500. This is a chart that we're looking at. Those of you listening on audio, podcasts, and such will tell you what we see. This is a 2-day chart. So this means every candle you see here, the red and green boxes at the top of the screen, are candles, candlesticks. You can look up our training at chartingwealth.com and learn more about candlesticks. You can also just Google it and read more. And we love candlesticks because they're a great way to see what the price movement was. On a red candle, the beginning price is shown at the top and the ending price at the bottom. Means that the stock went down, or whatever it is you're looking at, the equity went down for the day. You can chart anything. Originally, candlesticks were charted by candlestick traders. These were people who were trading rice in Japan. And what we're looking at is we can see that we have 3 down candles followed by a green candle that ended last week. We had 3 down red candles and a green candle. Now, what's so interesting as far as our training goes, looking at the S&P 500 chart, we see that we have 3 down candles, each representing 2 days apiece, so that's 6 days, followed by a green candle. The down candles show us a lot of things. First, if we go back to the 6th of August, we see that it's not quite a spinning top, but the red candle is small. It's not very long, but it has a huge wick on top and a long wick on the bottom, about the same size. What does that tell us? Well, it tells us that the bulls were able to drive the market up substantially. The bears were able to drive it down substantially, and for that 2-day period, it ended down. Means the bears were able to drive it a little bit lower. The bottom wick shows us how far they were able to drive it down and how far the bears or the bulls were able to drive it up. Now, the next candle on the 10th, we see that there is more movement down. The bears were able to drive it down, but the bulls were able to drive it down, but the bears were able to drive it up. And when I'm saying bulls and bears, bulls are the people who are buying things and driving prices up. Bears are the people who are selling things and driving prices down. Okay? So the bears were in control on the 10th. Now we see on the next candle, which represents the movement over the 2-day period around the 12th, we had a lot of down movement, but a whole lot more down movement that was pushed back up by the bulls. So the people who wanted to drive the market up were able to counter a lot of down movement by the bears. What you see next, the way that the week ended on the 14th, that candle shows us that indeed the week ended with very little movement. All of it was within the down candle by the bears, and there is movement going down and movement going up, but the way that the candle ended, it was up. Now, what does that actually tell us? Well, it's interesting. As we look at the pattern that had developed, we can see if we look down the screen, which is our MACD, which is our #1 indicator. It's the moving average convergence divergence. We have training on the site that'll tell you more about the MACD and why it's so important. You can also just look MACD, moving average convergence divergence. If you just search that, you will find out more about it. We also see the derivative oscillator had flipped over sometime around the 10th, although over the last 2 candles, it didn't do much. It pretty much stayed the same, and it is almost impossible to tell. It looks like the red is above the blue, but they're almost laying on top of each other as far as the MACD and the MACD's signal line. Now, what is that showing us? Well, it shows us that even with all the down movement that the bears were able to pull the market down, the bulls were able to counter it, and the way that the week ended with a green candle, it's really a spinning top, a lot of uncertainty. However, it goes to show you that the bears were not able, with all of the down movement that they tried throughout the week, to hold the market down, to hold the SPY, the Standard & Poor 500, down. Now, what can you draw from that? Well, that there's not a lot of downward pressure as the week ended on the market. In fact, for all the downward pressure, it was countered substantially by the forces that want to move the market up. What does that mean for us as we come into Monday? Well, it means that the market's in flux. This is, of course, the summertime trading zone. There's not a lot going on in the market right now because a lot of the volume is out of it. It'll come back in as we enter the fall-winter trading zone. There's a saying in the market, sell in May and go away. What does that mean? Well, it means that a lot of the big money leaves the market, so the market's more likely to sort of meander and not have a lot of good, solid up or down movement. It can be a little bit herky-jerky, as one can see when looking at the chart, going back to the 27th of July, where it touched trying to go down and then sort of bounded along. And it's been in a very tight range for the last many days. So what is that telling us? Well, telling us a lot of uncertainty. Now, if you had to bet, and we don't, you could try to say, well, it looks like the bears just don't have enough power to drive the market down, and it's trying its best to go up. Now let's back out and see the shorter chart that we look at, and that is the 4-hour or the half-day chart, and it actually crossed over going up on our MACD yesterday, well, that is Thursday afternoon, and on Friday it didn't have a lot of response in the morning. However, it did cross over and moved up. We can see the derivative oscillator heating up, and we can see that as the market ended the day, it pushed up. There was almost no down movement on the candles starting on around the afternoon of the 13th, on the morning of the 13th actually, on into the afternoon of the 13th, the 14th, and on into the afternoon of the 14th. So that crossover going up, along with that is on the MACD, and the up movement in the derivative oscillator shows you there's more of a push to push this market up as the week ended. Candlesticks can be helpful, but you never view them in a vacuum. You always want to use a good indicator, and our favorite indicator is the MACD. Now, if you don't have our chart, we'd be happy to send it to you. All you have to do is email us at chartingwealth.com. That email address is cw@chartingwealth.com. You can find it on our website, chartingwealth.com. We'd be happy to share that with you. That's our training portion of the show. You know where SPY is right now. Now let's drop back. We're going to go back to the 2-day chart, and we're going to go to IYY, which is the total market. Looks very similar. You can see that the MACD did cross over on the total market going down. Derivative oscillators held about the same, maybe reduced a little bit over the course of Friday, and the chart looks very similar on the total market as to the SPY, which is typical. The reason is because the total market is made up of all the stocks. The SPY is made up of the 500 big stocks. So a lot of times you'll see some parallel. They won't be the same, but we always like to look at the total market, and we like to look at the S&P 500. Now let's go over and take a glance at the Qs. What is the Qs? QQQ, sometimes called the cubes. That actually is the NASDAQ 100. So tech stocks. What have they done? Well, they crossed over on the big 2-day chart around the 10th going down. They crossed over at about the same time the derivative oscillator flipped. That's usually a good sign for a strong downtrend. We did see the charts on the NASDAQ 100 moving down on the 10th and on the 12th and on into the 14th. That was Friday. What do we look at when we drop back and see the 4-hour chart? We can see there was some up movement, but attempting to cross over going up, but a lot of sideways momentum. So the Qs doesn't have near the amount of push up at this point over the last day and a half or so that you saw before. But we did see around the 12th, the large movement down on the 4-hour chart was then followed by a spinning top, which shows potentially a change in movement, and then up movement on the 13th, and then sort of a sliding sideways through the afternoon of the 13th and the 14th. So you may see some up movement on the Qs, but it is currently in a confirmed down move, although slightly. For Friday, it was up 0.15%. Now, lastly, let's range out to the 2-day chart once more and go to gold. What has gold been doing? Well, looks like gold has hit a bottom. We've actually drawn a trend line. The movement today, over the course of Friday rather, was the 2-day candle that ended on Friday, was actually moving up. A pretty big acceleration on our derivative oscillator, a crossover going into the 12th, moving up. Gold appears to have reached a bottom. Let's look at the 4-hour chart just to see what gold did over the course of Friday. Looks like it, on at least the short chart, it peaked around the afternoon of the 12th and then moved down on the 13th and down a little bit on the 14th, really more of a sideways movement. It's not closed below where it started moving up aggressively at the end of the day on the 12th. So gold is again in a confirmed up move, maybe losing a little bit of momentum on the short chart, but on the long chart, the big chart, it's at a confirmed up move on the 2-day chart. Hopefully it's reached a bottom as far as its dropping goes. So maybe some good news for gold. We appreciate you joining us every day. We actually give you this broadcast every day. If you don't receive it, you can go to chartingwealth.com, sign up for a newsletter. You can also follow us on Facebook and Twitter. We'd love to hear from you. Please comment to us, send us your emails. If you'd like our charting layout from freestockcharts.com, all you have to do is ask for it. Sign up for our newsletter. We'll be happy to send it to you. Thank you so much for tuning in to chartingwealth.com.